Alternative risk financing and non-traditional financing options. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses alternative risk financing and non-traditional options. In this video, you will understand the meaning of risk financing techniques, traditional and non-traditional risk financing methods, alternatives to insurance companies, and insurance products for financing business risks. Let us start by explaining risk financing techniques before considering alternative risk financing and non-traditional risk financing options. Risk financing and risk financing techniques. Risk financing entails efforts and plans of an organization to pay for loss or finance its risk exposure if they crystallized. Risk financing focuses on ways of financing and monitoring an organization's risk exposures. Hence, it is suitable for organizations to have a good risk finance technique to fund organizational loss before its occurrence. There are two categories of risk financing techniques, which are risk retention and risk transfer. Risk retention. Risk retention, also known as retained risk, refers to accepted or retained risks, consciously or unconsciously, by an organization. There are two types of risk retention: 1. Active or planned retention, and 2. Passive or unplanned retention. Risk retention is a risk financing technique aimed at generating funds within or outside a firm to pay for or finance losses retained by the organization. Funding of retained risks. Funding of losses arising from retained risks, that is risk retention. There are three methods through which organizations could fund or pay for losses that arise from retained risks. 1. Pre-loss funding. This refers to the way of funding retained risks where a fund is budgeted aside to take care of retained risks before the occurrence of a loss or losses. 2. Current loss funding. Current loss funding refers to situations where no fund is budgeted to take care of retained risks, but a fund is generated after a loss to finance the loss or make good the loss. 3. Post-loss funding. This refers to the way of funding retained risks where a loss is paid after a loss using borrowed funds or some other method of raising funds to finance retained risks when they crystallized. This implies that retained risks can be financed within and outside a firm, internally and externally. There are two ways of funding retained risks: 1. Funded retentions, and 2. Unfunded retentions. Funded retentions. Funded retentions are retained risks that are active retentions that are budgeted for in the company's budget. Funded retentions are active retentions. Funds are budgeted to finance funded retention, and an arrangement is made before the loss to fund retained losses. Consequently, there is a pre-made arrangement for the financing of funded retentions. Unfunded retentions. Unfunded retentions are passive and unintentional retentions without pre-arranged funding. Unfunded retentions are retained risks that are passive and unintentional retention that is budgeted for by an individual, households and organizations. With unfunded retentions, the fund is not set aside or pre-arranged to fund or finance retained losses. The fund is set aside for the payment of unfunded retentions before the loss. Hence, there is no pre-made arrangement to finance unfunded retentions. The implication is that most of the unfunded retentions within business organizations are passive retentions. Risk transfer. Risk transfer entails transferring risk or shifting the financial consequences of a loss to another party through insurance and non-insurance techniques. Let us discuss the transfer of business risks through insurance and non-insurance techniques. Insurance. Insurance is a funded risk transfer mechanism that facilitates the transfer of financial consequences of specified loss exposures from one party, known as the insurer, to another party, known as the insurer, in exchange for a premium payment. I would suggest that you see our videos on insurance and risk financing for detailed discussions on financing risks through insurance. Many companies buy insurance to hedge against the different kinds of risks, including the risk of property damage, risk of fire, risk of plant destruction, and the risk of liabilities. When a company buys the insurance, it pays a premium to shift the risks to the insurance company. The insurance company the firm prefers over the others depends on the advantages and disadvantages offered by each insurer. The main advantages of hedging risk with insurance are: 1. Insurance companies have the expertise to price the risk reasonably due to their considerable experience in the same field. 2. Insurers also have experts who give advice on measures to reduce risks and may offer reasonable premium policies to the clients who follow their advice. 3. Due to the specialization, insurance companies may provide low-cost claims administration services. 4. Insurance companies have the capacity to pool risks since it holds a large and diversified pool of assets. It is also good to highlight the limitations of hedging risks with insurance. Here are some disadvantages of hedging risks with insurance. 1. The administrative cost of insurance is very high. 2. Often, the insurance companies face the problem of adverse selection wherein it is difficult to distinguish between the good and bad risks. 3. The high loading cost, which represents the difference between the premium amount and the expected payoff from the insurance policy. Thus, insurance is the most common form of hedging tool which companies use to protect themselves against risks and uncertain losses. Non-insurance risk transfer. Non-insurance risk transfer is a risk financing technique that facilitates the transfers of all or part of the financial consequences of losses to another party other than an insurer. There are two primary forms of non-insurance risk transfer, which are 1. Hold-harmless, indemnity, agreements, and 2. Hedging. Hold-harmless agreements. A hold-harmless agreement, also known as indemnity or no-fault agreement, is a contract whereby a party, known as the indemnitor, agrees to undertake the liability of another party, known as the indemnity, due to the occurrence of specified events. Hold-harmless agreements are suitable for more than one party working together on a project or providing services to another party. A hold-harmless agreement may also be applicable if a party, for example, a property or equipment owner, allows another party to use his property or equipment to protect the owner against liability that might arise when the property and equipment are used. A hold-harmless agreement is suitable for use in some sectors and contracts, including real estate, construction industries, and car rental companies. It is worth emphasizing that a hold-harmless agreement may not be enforceable in some situations, for example, where the indemnity negligently caused an accident. Hedging. Hedging is a financial instrument through which one asset is held to offset the risk associated with another asset. Hedging is a financial instrument that is aimed at reducing the expected loss. By hedging a risk, an individual and organizations will reduce risk and losses in times of uncertainty. Hedging can be applied to any business transaction or undertaking to reduce risk and ensure financial security. Hedging works based on the concept of assuming the worst-case scenario for a set amount of time to reduce the possible loss. A derivative is an effective form of hedging, and the main types of derivatives include 1. Forwards, 2. Futures, 3. Options, and 4. Swaps. Now, let us discuss these main types of derivatives, that is forwards, futures, options, and swaps, for hedging. Risk hedging with forward contracts. A forward contract is an agreement between two parties wherein they agree to buy or sell the underlying asset at a predetermined future date and a price specified today. Forward contracts are the most common way of hedging the foreign currency risk. Foreign exchange refers to the conversion of one currency into another, and while dealing in the currencies, there exist two markets, spot market and forward market. The spot market means where the delivery is made right away, while in the forward market the payment is made at the predetermined date in the future. In the spot market, the rate is the current rate, which is prevailing at the time the currencies are being exchanged. Whereas the rate in the forward market is the rate that has been fixed today or at the time the transaction is agreed to. but the actual delivery takes place at a specified date in the future. Thus, forward currency contracts enable the parties to the contract to lock the exchange rate today, to buy or sell the currency on the predefined future date. The party who agrees to buy the underlying asset at a specified future date assumes the long position, whereas the seller who promises to deliver the asset at a rate locked today assumes the short position. In a forward currency contract, the buyer hopes the currency to appreciate, while the seller expects the currency to depreciate in the future. Where the spot rate is the actual rate prevailing at the future date while the contract rate is the rate that was locked at the time transaction was agreed upon. Hence, forward contracts are similar to the options in hedging risk, but there is a significant difference between these two. The parties to the forward contracts are obliged to buy or sell the underlying securities at a specified date in the future, whereas, in the case of the options, the buyer has the right to whether exercise the option or not. The other difference is that the forward contracts do not require any upfront payment in the form of premium, which is very much required when buying the options contracts. Risk hedging with futures contracts. The futures contract is a standardized forward contract between two parties wherein they agree to buy or sell the underlying asset at a predefined date in the future and at a price specified today. The futures contracts are a relatively less risky alternative to hedging against the fluctuations in the currency market. The parties to the currency futures contracts fix the rate today while the actual payment or the delivery is made on the specified date in the future. There are two types of futures, commodity futures and financial futures. In the commodity futures, the contract is for the commodity such as cocoa or aluminium, while the financial futures refer to the future contract in financial instruments such as treasury bills, stock, or currency. The investor has a choice to exchange his currency either in the spot market or the futures market. In the spot market, the currency is exchanged at the current rate and the payment is made right away, whereas, in the future market, the exchange rate is fixed today while the actual payment is made at the defined future date. Where, the spot price is the current exchange rate prevailing at the time the currencies are being exchanged, while the contract rate is the rate that has been locked at the time the parties agreed to the transaction. Through this formula, both the parties to the futures contract decide whether they have incurred gains or suffered losses. Here also, the buyer hopes that the currency may appreciate while the seller expects that the currency will depreciate. Now the question may arise, that what is the difference between the forward contracts and the futures contracts because both instruments look alike? There are significant differences between these two tools, that is forward and future, of hedging. Let us discuss the difference between forward and futures contracts. Difference between forward and futures contracts. The future contracts are the standardized forward contracts wherein two parties mutually decide to sell or buy the underlying asset at a predefined future date and at a price locked today. These are considered as a less risky alternative to hedging against currency market fluctuations. If the future contracts are the forward contracts, then why it is considered as a separate tool of hedging? Well, these contracts do look alike but are different from each other. Here are the main differences. Future contracts are the forward contracts. 1. The forward contract is a more customized contract wherein the terms are negotiated between the buyers and sellers, whereas the future contract is a standardized contract where date, quantity, and delivery conditions are standardized. 2. The forward contracts have no secondary markets while the future contracts are traded on the organized exchange. 3. In the case of a forward contract, usually, no collateral is required, whereas, in the case of a futures contract the margin is required. 4. The final settlement of the forward contracts is done on its maturity, whereas the future contracts are marked to market daily, which means the profits and losses of these contracts are settled daily. 5. The forward contracts often end with the deliveries, whereas the futures are mostly settled with the differences. It is, therefore, obvious that forward contracts and futures contracts are not the same because they are used for different purposes. Risk hedging with options. An option is an agreement wherein the seller grants the right to the buyer, not the obligation to buy or sell the security at a predetermined price for a specified period. An option is a right and does not constitute an obligation on the part of both the sellers and buyers to buy or sell the underlying security at a predefined price during a specified period. A foreign currency option is the most flexible derivative that helps in reducing the foreign exchange risk. Let us assume that a Nigerian manufacturing company wishes to import spares in bulk. The company should know that the price of the spares might increase in the future. To tackle such a situation, the company may buy the options to lock in the price of spares today and take the final delivery on a specified future date. To buy the options, the company must pay a premium to the option seller. If the price falls, then the buyer has the right not to exercise his option and can buy the spares from the spot market. The options contracts on interest rates and commodities will also help the managers to manage the financial risk efficiently. Hence, the options provide protection against the risk and benefit from the changes in the currency or price. Risk hedging with swaps. A swap is a financial agreement wherein the parties agree to trade cash flows over a period. It is the portfolio of a forward contract that involves multiple exchanges over a period, while the forward contract involves a single transaction at a specific future date. Swaps are highly liquid financial derivatives and have the following distinct features. 1. It involves the effective translation of fixed-rate borrowing to floating-rate borrowing and vice versa. The difference in the interest amount is either paid or received. 2. It applies to both the new and the existing borrowings. 3. In accounting, it is treated as an off-the-balance sheet transaction. 4. It is a distinct contract from the underlying loan agreement. 5. There is no exchange of principal repayment obligations. The swap contracts are a more flexible financial instrument and can be used in many situations. The two most common forms of swaps are currency swaps and interest rate swaps. These two swaps can be combined in case the loan is in two currencies and needs to be swapped. Currency swaps. The currency swap includes the exchange of cash payments in one currency for the cash payments in another currency. In a currency swap contract, the principal and interest in one currency is exchanged for the principal and interest in another currency. Hence, currency swap includes 1. Exchange of principal amounts, 2. Exchange of interest payments during the term of the loan, and 3. Re-exchange of the principal amount at the maturity of the loan term. Often, the international companies find difficult to raise foreign currency to make the investments in abroad, and therefore, the currency swaps are used to overcome such problem. For example, if a Nigerian company wants to make an investment in the United States, US, but the US government regulations restrict the purchase of US dollars to make the investments. In such a situation, the Nigerian company is allowed to lend naira and borrow US dollars, and to do so, it might find the company in the US that requires Nigerian naira to invest in Nigeria and would lend rupee to that company and borrow US dollars in return. Interest rate swaps. The interest rate swap contract includes the exchange of one stream of interest obligation for another. It is the form of transaction that allows the company to borrow capital at a fixed interest rate and exchange its interest payments with an interest payment at a floating rate and vice versa. Having highlighted a general overview of risk financing techniques, let us discuss alternative risk financing and non-traditional options. Alternative risk financing and non-traditional options. Several alternative risk financing techniques and products at business organizations can mitigate and transfer risk beyond the traditional insurance risk transfer technique. There are two broad categories of alternative risk financing products: 1. Alternatives to insurance companies, and 2. Alternatives to insurance products. Alternatives to insurance companies. Alternatives to insurance companies refers to risk financing techniques provided by organizations and institutions other than insurance companies. There are different types of risk financing alternatives to insurance companies. Examples of alternatives to insurance companies include 1. Self-insurance, 2. Insurance pools, 3. Captive insurers, and 4. Risk retention groups. Now, let us discuss these alternatives to insurance companies. Self-insurance. Self-insurance is an effective alternative to insurance companies in managing risk. Self-insurance is a strategy for saving cash flow and creating an insurance plan against future losses. Self-insurance entails setting aside funds to finance a risk or pay for a possible loss rather than insuring the risk with an insurance company. Self-insurance works the same way as insurance. However, self-insurance allows individuals, households, and organizations to control their risk management by managing and financing their risk exposures. This means that self-insurance allows individuals, households, and organizations to mitigate risks without relinquishing control of their funds and assets. Self-insurance is the direct opposite of purchasing an insurance policy by individuals and organizations. Self-insurance enables a firm to retain an eligible risk while designating money to compensate for the potential future loss. Self-insurance does not mean that an organization has not or will not take up or purchase insurance, that is commercial insurance contract, from an insurance company. An organization can manage its risks through both self-insurance and commercial insurance. This implies that self-insurance can serve as the first layer of coverage. An insurance policy is purchased from the commercial insurance market to cover losses above the self-insurance limit. Consequently, many organizations have increased the amount of risk that they self-insure. For example, an organization may decide to retain a specified risk to the tune of $10 million and insure losses arising from the event above the retained risk, that is $10 million, to the tune of $25 million. Hence, an organization can purchase commercial insurance to cover risks over or above self-insured retention. The implication is that organizations can engage both self-insurance and commercial insurance to manage their risks. Therefore, commercial insurance will provide coverage above the retained self-insured amount at a reduced premium. Insurance pools. Insurance pools are an extension of self-insurance. A group of insurers and reinsurers creates insurance pools to combine their resources to underwrite one or more specialized risks. An insurance pool consists of insurance companies, with similar risk profiles within a sector and geographical location, who have agreed to share profits and losses of the pool based on joint liability arrangements. Insurance pools' specialization might be on a class of business, for example, automobiles, marine, aviation and liability pools, and an event, for example, flood and natural catastrophic risk pools. Insurance pools are beneficial to the insurance industry because it enables insurers to mobilize their expertise and capabilities to undertake large risks beyond individual insurer capacity. For example, insurance companies may form an insurance pool to provide flood or earthquake insurance coverage in flood and earthquake-prone areas. Members of the pool will contribute premiums to a fund and administer the pool. Surplus funds may be reinvested into the pool or shared among member companies at the member's discretion. Captive insurer. A captive insurer is an insurance company owned and controlled by an organization or group of companies. A captive insurer is an insurance company established by a non-insurance parent company to insure risks of the parent and sisters companies. This is the basic form of a captive, but a captive can also insure firms' risks outside its group of companies. A captive insurer provides insurance protection to its owner, and the owner enjoys paying lower premiums and benefits from the underwriting profits. Captives have some advantages over traditional insurance companies. An organization and group of companies can establish captive insurance companies to self-insure their risk, rather than insuring their risks with traditional insurance companies. Companies that set up the captive are the shareholder of the captive insurance company. Captives enjoy cash flow benefits through payment of lower premiums, retention, and investment income. Captive insurance helps the parent and sister companies, group of companies, enjoy the additional protection that others cannot access. These companies would enjoy an unparalleled level of transparency, accountability, and customer service from the policy provider. Captives also enjoy tax benefits. For instance, Captives that provide employee benefits insurance enjoy some tax benefits. Risk retention groups. Risk retention groups are like multi-owner captive insurance companies or self-insurance groups. Companies with similar risk management objectives form risk retention groups or risk groups. Risk retention groups are liability insurance companies owned by their insureds, who have engaged in a similar business or been exposed to similar risks. Risk retention groups are licensed under the Liability Risk Retention Act of 1986, which permits the insurance company to insure members in all states within the United States of America. The primary purpose of the risk retention group is to continuously improve risk management within members of companies by understanding their risk exposures, capacities, strengths, and vulnerability. Risk retention groups are innovative in that they look at retention strategies across members' operations and sectors. Risk retention groups use surveys, focus groups and decision-making algorithms to help improve retention of high-risk customers who have declined other offers. These tools help groups develop structured actions and systems to ensure the highest retention rate for high-risk accounts. By achieving high retention results group-wide, companies can then leverage these results for marketing campaigns and advertising within the targeted market. Risk retention groups enjoy several benefits, including members' ability to control their programs, coverage at affordable rates, and direct access to reinsurance markets. Risk retention groups cannot underwrite certain risks, including employers' liability and loss from personal or household responsibilities. Having discussed alternatives to insurance companies, now let us identify alternatives to insurance products. Alternatives to insurance products. There are alternatives to insurance products. Many of the alternatives methods to insurance products are products and instruments of the capital markets. Studies have shown that the global capital markets have far beyond that of the insurance markets. The world's capital markets are generally diverse enough to handle the risk of natural disasters without increasing prices too drastically. There are several alternatives to insurance products. Many of the alternatives methods to insurance products are products and instruments of the capital markets. Studies have shown that the global capital markets have far beyond that of the insurance markets. Hence, the global capital markets can handle natural disasters and other severe risks at a lower cost across several continents and markets. Alternatives to insurance products include 1. Credit securitizations, 2. Cat bonds, 3. Weather derivatives and 4. Finite risk products. Let us consider the benefits of these alternatives to insurance products. Credit securitizations. Credit securitization is a process of borrowing money to finance assets. Financial institutions and other asset holders use credit securitization to protect their interests in an asset when purchased or sold. Credit securitization typically involves lending funds to buy or refinance an existing outstanding loan, typically secured by property or equipment. The objective is to provide the borrower with cash at the acquisition time and reduce or eliminate outstanding debts with new equity capital. The collateral used for this purpose may include first lien or business property, sometimes known as commercial real estate. The process of acquiring new credit is often complicated and time-consuming. This can lead to consumers becoming financially vulnerable when their loan payments become due. Hence, credit securitizations can be used to stabilize and expand credit lines. For example, banks use securitization to increase the value of their loans by creating capital when needed, thereby requiring less cash from borrowers when they can pay back. Consequently, some companies can offer borrowers low interest rates and attractive terms on their loans. In contrast, others may offer better terms and lower interest rates for borrowers with good credit. Similarly, proceeds of the sale of asset-backed securities can be remitted to the transferor of the assets. This entity otherwise would have purchased insurance to defray its credit risk. The purchasers of the securities assume the risk of recovery of the assets. Catastrophe bonds. Catastrophe bonds, Also CATS bonds, are risk-linked securities aimed at transferring specified risks from the issuer to the investors. They are usually structured as corporate bonds whose repayment of the principal is forgiven if certain specified trigger conditions are met. Catastrophe bonds are debt instruments used by insurance and reinsurance companies to raise funds for and spread risks associated with natural disasters or catastrophic events such as hurricanes, earthquakes, and tornadoes. The bond issuer will only receive funding from the bond if a pre-specified natural disaster, for example, earthquake, flood, and tornado, occurs. Hence, catastrophe bonds are event-linked securities used by insurance companies to raise funds after a natural disaster to finance a pre-specified catastrophic event. CAT bonds have a short maturity period of between 3 to 5 years. Hedge funds, pension funds, and institutional investors are the primary investors in catastrophe bonds. CATS bonds are structured corporate bonds whose repayment of principal is forgiven if certain specified trigger conditions are met. Catastrophe bonds are used to fund events with high severity and low frequency. If the specified event does not occur, the investors will enjoy a return on their investment through interest payments and repayment of the principal over the bond's life. However, if the specified event occurs, the investors may lose their rights to some portion of the principal or the entire principal, which the issuer retains to pay the loss. Weather derivatives. Weather derivatives are financial instruments that companies can use as a risk management strategy to reduce the risk associated with adverse or unexpected weather conditions. Individuals and organizations can use weather derivatives to hedge against the risk of weather-related losses. A weather derivative contract consists of two parties, seller and buyer, whereby the seller agrees to bear the risk of disasters in exchange for a premium paid by the buyer. If no damage occurs within the contract period, the seller will make a profit, but, if the unexpected event or adverse weather occurs, the buyer of the weather derivative will claim the agreed amount. Weather derivatives are, therefore, designed to compensate companies for lost revenues arising from unseasonable temperatures. The implication is that weather derivatives can be used to hedge against the risk of weather-related losses in some sectors, including agriculture, tourism and travel, and energy sectors. For instance, farmers can use weather derivatives to hedge against poor harvests due to lack of rain or unseasonable snowstorms. On the other hand, event management firms might use weather derivatives to insure against rainy weekends during an event. Finite risk products. Finite risk products are insurance products that have relatively low payout and high expected complexity. Unlike typical insurance contracts, which typically have a duration of 12 months, finite risk insurance products have a longer term, say, 10 years. A finite risk product, FRP, is an insurance product in which the risk of loss is limited to a specified amount, with a specified payout amount when the risk crystallized. Finite risk products are a type of risk management strategy in which the rewards are limited and known in advance. The concept of a finite risk product is straightforward. It is a product or service with a high likelihood of failure, typically with a low expected value. For example, the most popular financial product is a credit card. A credit card is finite in that if a customer does not pay off the balance in full each month, the credit card company will retain the money and possibly force the customer to pay more interest. These products are often referred to as finite risk because they do not use expected value or cost recovery as their primary criteria for pricing. However, they are assessed based on a mathematical formula of risk exposures. This allows investors and risk managers to limit their exposure without putting money at unnecessary risk. Finite risk products are products that have a small but measurable risk of causing an essentially irreversible loss. Finite risk products are suitable for individuals and companies willing to take calculated risks and are likely to have more than enough capital to protect themselves if something goes wrong. Finite risks products can be used for several purposes, but the most common application is a sub-insurance option for complex products. Finite risk products are beneficial where the risk exposure is a high severity with low frequency event, such as an oil spill over a specified period, for example, 10 years. Conclusion. This video has discussed alternative risk financing and non-traditional financing options. Specifically, we discussed risk financing techniques, traditional and non-traditional risk financing methods, and alternatives to insurance companies and insurance products in financing business risks. There are several ways of financing business risks. Businesses can engage various alternative risk financing techniques and products to mitigate or transfer risk outside of the traditional insurance-based model. Insurance is a primary traditional risk financing technique, but there are alternatives to financing products through insurance companies. The two categories of alternative risk financing products are alternatives to insurance companies, and alternatives to insurance products. Alternatives risk financing techniques to insurance companies include self-insurance, insurance pools, captive insurers, and risk retention groups. Some of the alternative methods to insurance products are capital market products and instruments. There are also several alternatives to insurance products, including credit securitizations, cat bonds, weather derivatives and finite risk products. I hope the video is educative and beneficial to you. We love to hear from you. Kindly post your comments below in the comments section. If this video has been educative and beneficial to you, then, give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comments section below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.